Are you surprised that a $100 billion takeover could be spurned?
I'm not surprised that either the acquirer, InBev, is trying, nor that the target SAB is resisting. I think there's probably, I think Duncan's right, there probably is a little bit more give on price if this is going to negotiate out. But what I wanted to say was I think that quite separate from price, there are some real serious regulatory issues in this. I think you can see that in the fact that the stock price of SAB has not traded up quite close to the assumed offer price.
Right.
There is a high concentration of market share in the U.S. such that some pieces of the empire would have to be broken off, such as a joint venture that one of the parties has with Coors. And there's some other antitrust concerns in some of the emerging markets. So this thing is going to go into some extra twists and turns. I also think this is very much the product of the cheap capital era that we're in. This is using very, very cheap debt to make an all-cash offer for a very, very expensive company.
So to you, the timing is not at all coincidental, that it comes ahead of all of the speculation that we're going to see all this cheap money start to get more expensive?
Not at all. I mean, Janet Yellen is telling the world that as soon as she can, and as soon as she feels empowered, she is going to raise rates. We can't have such cheap money forever. This is a pricey company already. This company's SAB's shares have fallen. They've struggled a little bit. They've had some pressures on them. And when you put these two together, you're going to have some synergies, but you're paying a full multiple to get in there. Right. And you can only do that with the benefit of cheap capital, just as is the same situation in 3G Heinz and now the proposed Heinz-Kraft merger. These are very, very large consumer-driven deals driven by cheap capital and the expectation of a rising middle class in emerging markets.
Marshall, hang on. So, Duncan, Marshall makes a great point about regulatory concerns. I mean, what kind of divestitures might we see if this deal gets through?
I think it's spot on. The US certainly would have to go. China would be very interesting as well. You've got 23-24% where SAB market share, and around about 14 for AB InBev. So unless they can cobble together an interesting deal on brands, I think there's a big issue there as well. And apart from that, they may get away with a lot of the other markets, but clearly regulators are going to be all over this. When you've got a global company with 30% of the volume, a global volume, they're going to be all over it.
They're certainly going to be all over it. And I'm sure the lawyers are going to be all over this as well, Marshall.
This is a field day for lawyers. There's antitrust questions all over the globe. And, you know, antitrust is back. It was quiescent, indeed virtually dormant for the longest time in the late 1990s and first decade of this century, and it's back. It is coming back just as the hostile deal is coming back. This all may be the final act.
I wonder what does that mean? If there, what does that tell you?
We're in the era of very, very, very big mergers. We saw it in pharma, we've seen it in energy, and now we're seeing it in consumer.
But are we in the beginning or the end of that cycle?
Well, it depends on where you look. Look, even several years ago, AT&T, T-Mobile died over antitrust issues in this country, and AT&T paid a whopping $3 billion breakup fee for that effort. So I don't think anything can be easily predicted when you get into the scale of companies where something like 9 out of 20 top brands are going to be under one roof. This will be $55 billion in sales and $275 billion in market cap if you put this together.